Welcome to our stock trades. In this video, we're going to go ahead and talk about Bill Ackman's strategies in regarding to investing. We're going to pull up a podcast and we're going to react to a video of an interview of Bill Ackman that essentially talks about what he's planning on doing with his portfolio and essentially a general theme of value investors that fall in line from Benjamin Graham's era, from the intelligent investor, that have taught a lot of billionaires, before they became billionaires, investors when they were in their 20s and 30s to become billionaires. We're going to start seeing vocabulary terms such as discount rate, the present, a value of a business is its future cash flows discounted back to its present value. And the goal of this channel is to not only give analysis that's high quality and unparalleled, but at the same time, bring in different forms of ideals and ideologies and different perspectives within the investment world to show you how others are looking at it. The worst thing a retail investor could do is essentially just go with one investment thesis and stay with that investment thesis, because the issue is as you go to different terrains, different economic cycles, different times where certain companies outperform others, it's like essentially going into a mountain, going from a street, riding a bicycle to a mountain. You need to change bicycles. And my vision is to essentially present this to you and to give you some more, just another slice of information that you can use. So without further ado, let's go ahead and get started with this and play the video here. Let me know if you guys hear it. And if you're on Spotify, Apple Podcast, you can also go to YouTube at YouTube and search for Al Stock Trades, and you'll be able to find the actual video.
Is highly respected investor Bill Ackman from Pershing Square Holdings. Now, his portfolio is heavily exposed to US consumer through names such as Burger King owner, restaurant brands, Chipotle, and Lowe's. So, Bill, are you worried about potential recession hurting the US consumer, consumers starting to spend less, and of course this would feed through to lower earnings for some of these companies in your portfolio?
I would say the following. Where we are in the restaurant space is kind of the highest value per dollar, right? Chipotle is an incredible meal at a very low cost for a family. And in a recessionary environment, historically people don't stop eating out, but they might adjust from the sit-down restaurant, with menus and a waitress, to a fast food environment, or a place where they go pick up their own food at the counter. And actually the fast food, if you will, the quick service restaurants have generally done well in recessionary environments. And I think the overarching point that the value of a business, unless it's a highly levered, very economically sensitive company, is not particularly affected by the event of a recession, right? If you own the value of a stock, right, the value of an interest in a company is the present value of the cash that business generates over its life. And if it's
So he said something right now. The value of a business is its present cash flows generated over life. Now you may be asking yourself, what does that mean, present cash flows? Well, if you've been following us for the years, that's exactly how we evaluate companies. We evaluate companies by essentially sending off the free cash flows into infinity and discounting them back to its present value. Now, this may, when I first started investing 10 years ago, when I first heard about these terminologies, I was a little confused. I didn't know what this meant. But I did realize something. The retail community did not practice this type of investing, but billionaires and really successful billionaires do. And I've studied so many billionaires in my lifetime that I found a common link, a common thread that unfortunately is not taught within our educational system. And that essentially is its own discussion. But as you can see, we yet have another person, which is why he's part of our legendary investors in our Mastering Stock Market course, and also the brain machine models. We model our investment strategies and look at the SEC 13F filings of these brilliant investors to study them. And what better way to learn, I would say, far from a university, than to actually study billionaires doing exactly what we're all trying to do, which is essentially create generational wealth and learn how to master the art in value investing. Let's continue.
It's a business that should exist forever. I'll pick Hilton, for example. We can expect that in past history, there's been a recession every 7 or 8 years. Let's assume the future is the same, and there's a recession every 7 or 8 years going forward. It doesn't. That's kind of factored into the value of the enterprise. The only reason why a recession destroys value is you have a company that is highly levered.
And he mentioned something really important here. So when we do our intrinsic value calculations, we always assume there's going to be a recession, which is why we have such a high structured discount rate. I remember doing an intrinsic value calculation on PayPal, and a fellow value investor said, "No, this is incorrect. Your discount rate's too high." And my response was, "I'm discounting at a high rate in order to essentially offset a future recessionary environment / bear market, which is what we're experiencing now." See, when we always analyze companies, we always price that in our analytical form. And what ends up happening is if you have a stretched out future cash flow and you graph out cash flows, what you do is if we have a blip in negativity when a company's negative free cash flow because of a recessionary environment, the overall average will pick it back up. AKA, we've already anticipated it with a future higher enough discount rate to offset the destruction of temporary of free cash flow. The only time we have a problem is when a company is highly leveraged, as what Bill Ackman is saying here. And the way we calculate leverage, really a great way, there's obviously deeper ways, but just a way for people that are introducing themselves within the market, is to look at the current ratio where you essentially stack assets over liabilities. And what you want is you want to obviously have more assets over liabilities and analyze whether the liabilities are due in the short term or long term. And each of them have their own current ratio calculations. So the goal of investing is essentially to find a company that has a business model that is able to generate cash flow that is not highly leveraged, just so we go into a black swan moment or a recessionary environment, they will be able to survive rather than essentially go bankrupt, which is exactly what happens when companies are over leveraged, aka what is happening with FTX, Voyager Digital, and a lot of these companies, and soon to be, if they don't change their business model, Tattoo Chef, which a lot of retail investors, unfortunately, don't know how to analyze until it's too late in the game.
And then if revenues decline, their cash flow goes negative and they can't support their debt and they go bankrupt, right? But if you own a very well capitalized business, I don't think a recession has a meaningful impact. It might affect that year's revenues and cash flow, but that's just one line item in a long spreadsheet of cash flows that you discount, if you will, into the present. But the businesses we own, Universal Music being the largest one, and a good example, people are not going to, we think, cancel their Apple Music subscription because we're in a recession. It's the cheapest form of entertainment. It's 10 cents an hour or something like this. Compare that to a movie or a video game, you pay a lot more.
I mean, you sold a stake in Netflix this year after only owning it for 3 months. You sold your stake in Domino's. You only bought that last year. Aren't you a believer in long-term investment? Particularly with Netflix, obviously share price is up quite a bit since you sold it. So.
Yes. So we look for businesses we can own, so to speak, forever. Our favorite holding period is something we never need to sell. Universal Music, I hope, is something we'll never need to sell.
And this type of philosophy he learned from Warren Buffett. When we purchase companies, we like to purchase companies that we can essentially turn the stock into a bond and actually discount its future free cash flows to its terminal value and present value of where it actually is. So assuming that this business is going to last so odd number of years, what is the value of this business in today's present value? And how much am I going to be able to make from that value that I'm calculating to its intrinsic value? And is there a gap? AKA, is Mr. Market miscalculating the value of the company? Which is what we're seeing a lot right now with inside of the stock market, because a lot of analysts and a lot of businessmen, what we've seen on our private group, we're starting to realize that a lot of these folks don't actually do intrinsic value calculations. They basically reflect what Mr. Market is saying, and that has its pros and cons. Pros, you sound right during the time. The con is you're not accurately valuing the business, and the people that actually know how to do that are going to end up winning in the long run. Hence why Warren Buffett continues to accumulate wealth.
But we always reserve the right that if new information comes to light that causes us to reassess our original thinking, prepared to exit. And Netflix is really the traditional example of that. I mean, a business, what attracted us, stock was down from the middle 700s to high 300s on a subscriber miss that the company attributed to COVID, difficulty predicting kind of the COVID, Netflix was a huge beneficiary during COVID, and the thought was, they got a little bit off trend. 3 months later, they came back and said, well, we're not sure it's actually COVID. We think that we have a much larger number of unpaying, i.e. people who share passwords than we thought, or than we've at least disclosed previously. This is causing us.
And we talked about this in our past videos regarding Netflix. Once we saw the numbers and once we saw the trajectory of the company, we realized that Netflix needed to change their business model, aka introduce an ad version for subscribers that don't want to pay a higher monthly fee. And unfortunately, when you're valuing a company, the future free cash flows within that unfortunately get offset. Now, if we were in the beginning stages of streaming, where blockbusters were still online, then I would say I would be a little bit more confident in Netflix's ability to scale. But it's starting to become not so much a growth story, more than a value story, which means that they need to start acting like a value-based company, which they're not. They're still negative free cash flow. Another good example is, let's say, a company in the healthcare arena. What we're betting on right now is that we're getting approximately 10,000 Americans turning 65 years of age. And what we're betting is small insurance companies that are very scalable, that use technology to scale, which hasn't been done in the insurance realm. We're able to bet on that because the starting point to where we're going to go is such an it's like an S-shaped curve, that we can take that bet and are confident that we are going to have some form of return on investment.
Us to reassess our business model. We're going to go to an advertising model. And while we have enormous confidence in a management team that's done a fantastic job over many, many years, it's a completely new approach to their business. And I think for us, it made the future difficult to predict in terms of the future, what's going to happen. And we're a very concentrated investor. We put a large amount of capital in each commitment. We want these to be things that we can predict with a high degree of confidence over a long period of time. And Netflix became, if you will, unpredictable for us. So we sold it. And we sold it around $225 a share, $275 a share. And actually, I don't remember a precise exit price. It's trading above the price we exited, but that doesn't mean it wasn't the right decision to exit for us. An investor owns 100 stocks. There's a place for Netflix. An investor owns 9 or 10. In light of the uncertainty created by the changes in how they're going to approach their market, we felt it was not something that could fit into our portfolio. In general, we like to own things for the long term. On Domino's, we actually made a profitable investment over the course of the year. Our original holding period intention was not a year, but the world changed in a pretty dramatic way. One, it got a lot more difficult to get labor, a lot more difficult to find drivers, much higher interest rate environment. And the combination of those factors and the valuation that when we sold made it, in our view, just a less attractive opportunity. We'd rather deploy the cash elsewhere.
I mean, obviously the market has thrown up some big opportunities this year. Have you sort of been buying anything new recently?
So actually so we put our capital in 2 places. One, we launched one of the more aggressive buyback programs out there. We're buying in about 1.5 million shares, approaching about 0.75% of our shares outstanding every month. That's a pretty aggressive program. It's about 28% of the average shares outstanding. We think that's the easiest investment that we can make right now. One, we're well capitalized, plenty of cash on hand. 2, we're trading at, as you know, a 35% discount to NAV. 3, our companies are trading at, in our view, deep discounts to their intrinsic values. You get the benefit of that double discount.
So essentially what he's talking about is the discount rate. Now, to all of our mastering stock market students that have the ability to go on our intrinsic value calculation and change the discount rate for any company that you analyze, what you've seen is if you change the discount rate and continuously increase it to where you bring down the stock price to where Mr. Market is trading at, you start realizing that the discount rates for companies like, I believe, Clover is trading anywhere between 50 to 55% and some even higher. And what that basically tells you is that we expect a 50% return year over year until the company gets to its intrinsic value, wherever that may be. And it's very difficult to predict in a negative free cash flow company, but there's ways and strategies that you could use to essentially try to accurately predict it with a good margin of error.
So we think that's been a good place to deploy capital. The other place we've been deploying capital is some of these sort of more opportunistic hedges. We're investing a relatively small, maybe 1, 2, 2.5% of our capital in each of these various commitments together, comprising at cost, 5 or 6% of our capital. But investments we can make 6x, 8x, 10x, and sometimes more. That seems a better use of capital for our marginal dollar than the next big equity commitment. And we've looked at a couple of things that come closer to prices where we would own them, but stocks haven't really gotten cheap enough for us to take our last dollar and buy the next big commitment.
So I know that you like to take large stakes in companies, but not controlling stakes. But of your existing holdings, then, is it in terms of which ones you'd buy more of? Is there any sort of them that they're approaching a level which actually don't want to increase?
No, I mean, I think we'd buy more of anything we own at the current price, with the only caveat being how large a percentage of the portfolio any individual position might be. So the only position we're trying to increase as we speak, I have to be cautious in how I speak about it because we have an ongoing tender offer, but Howard Hughes stock, it was one of our smaller positions, down at 1.40+% for the year, and we made an offer to the other shareholders to buy an incremental 13% of the company, and we'll find out in the next couple of weeks what percentage we get. But that's the only thing that we're buying right now. And although in effect, when we buy back shares, we're buying a proportional interest, obviously.
Great. So essentially, I hope this video was helpful for you in essentially bringing another investor who's been very successful for the many years, and to give you an insight on how to become a critical value investor. Because I feel like sometimes retail investors, they spend too much time on the technicals, and they lose sight of what a business is supposed to do, which is generate free, future free cash flows. So what we're going to do is we're going to try to find other videos out there and try to bring in insight. And, if you watch this video, by the time, 2, 3, 4 years down the line, you're going to gain a wealth of knowledge just from our channel. And for our mastering students that are also watching the YouTube channel, this will give you an opportunity to take this knowledge and apply it with the tools that we've given retail investors and democratized it that would normally cost tens of thousands of dollars every month. So if you like this video, consider liking, subscribing, and commenting, and let me know if this is the type of content that you want to see that will add, in my opinion, value to your investment journey. Love each and every one of you guys. I will see you on the next one.